Welcome to the Commercial Property Podcast. My name is Suzi Carter. I am a chartered surveyor. I've been involved in commercial property in the UK for 30 years and I've done hundreds of commercial property deals. I'm here to be your guide through the commercial property market, whether you're an experienced investor or whether you're literally thinking about dipping your toe in the world of commercial real estate. I will be here talking to you about all kinds of things commercial real estate in the UK, and I've also got some fantastic guest experts who are joining me. So please do subscribe if you'd like to follow, and if you'd like any more help or information on commercial real estate, please do click www.suzicarter.com, which is my website, and you can find out all the ways I can help you. So stay tuned for this week's episode. So I'm going to talk to you about commercial finance. So as with all topics involved in finance, on first blush, that might not seem the most exciting thing I'm going to talk to you about. However, if you understand something about what banks like to lend on, then it can really govern your sourcing strategy and it makes you more laser focused. And niching is really the name of the game in commercial property. What we're looking for is to niche our strategies, and understanding of finance can really, really help that. Now, let me just talk a little bit about niching, and I'll do a full podcast episode on niching so that you can understand it a little bit better for those of you who don't niche already. But because there's so many different types of businesses that occupy commercial property, that means there's so many different types of commercial property. So we like to group them into retail, office, industrial, leisure, hospitality, healthcare. But actually, within those asset classes and beyond, there are so many different types of businesses. So that's why I call it micro niching. That's why you can micro niche into lots of different types of commercial property. And I'll put the link below in the show notes in terms of my micro niching webinar, and so that you can understand a little bit more about niching if you haven't listened to that already. So when we're niching, there's certain things we need to look at, and what we basically need is a hook that we can niche, where we can actually niche, a hook that we can use to refine our niching. And finance can certainly be one of those hooks. So obviously there's lots of different ways that you can invest in commercial property and raise money for commercial property. Obviously you don't need to use commercial finance at all. In fact, in today's market, being a cash buyer can really get you the best deals, because what vendors are looking for, because we're in a down market, because everybody's looking for speed and certainty, then cash purchases are actually really preferred by vendors. So cash ideally, but obviously you can use a bridge, and we'll talk about that in a minute as well. So, and you can also obviously raise private finance as well. I'm not going to cover that today, but if you do want to know more about private finance, we will discuss that in a future podcast episode. Today, I'm going to talk about bank finance and different ways of financing commercial property. Now, what I'm not going to talk about is development finance, so mezzanine finance, senior debt and all that kind of thing. Obviously, that is very much tied up with commercial finance. And if you're going for development finance, I will get a development finance expert to come on and talk about that at some point. But what I'm going to talk about today is how you can niche your strategies by understanding commercial finance. So let me get into the nitty gritty of it. So when you look to raise finance, even if you're a cash buyer, you want to understand how a bank is going to value the commercial property. Now, when markets dip, commercial finance always locks up. That's just a fact. This is my third downturn that I've experienced, my third market cycle, and I've seen it happen time and time again. So commercial finance gets jittery when the market drops. They reduce loan to values, and interest rates tend to rise anyway. So the cost of debt raises and the loan to values fall. So that's exactly what happened after Liz Truss's mini budget in 2022. The market got jitters, commercial finance locked up. Simultaneously, interest rates were rising, and therefore it became this perfect storm of expensive debt, basically. Now, since then, there's more confidence in the market. The window of opportunity is definitely still open. I can't see that closing, at least in the first 6 months of this year. Maybe at the top end of the market, there's definitely some green shoots. There's definitely more deals being done. Banks are getting more confident, but still restricting. But here's the thing, there's certain types of things that they really like to lend on, and that's what we're going to talk about today. Because if you can identify those types of property, then that means that you can actually get debt much easier. You can get cheaper debt, and you can get higher loan to values. And even if you're buying cash, even if you're a cash buyer, or you're using private investors to buy the property, or JV partners, or whatever else it might be, here's the thing. You need to make sure that you are buying the property as if you're getting debt. So what does that mean? Well, at the moment, because commercial finance has been a bit jittery, what they have been doing is most of the banks have been instructing their valuers, because obviously whenever you get a mortgage, a valuer goes along and does a valuation. They have been instructing their valuers to value on vacant possession value. So what does vacant possession value mean? Well, basically, in very simplistic terms, it means the bricks and mortar value. But really what valuers are going to do is that they're going to look at the property as if it's vacant, and they're going to say, right, if this property was vacant today, and of course it might be vacant, but very often it's occupied when they're assuming vacant possession value. So if this property was vacant today, how long would it take to get let? And so what they do is they would work out how long they thought it would take to let in the market, and then they'd work out the valuation that way. So the trick with that kind of property is to find properties where the vacant possession and the market value, vacant possession value and market value are very close together. So what do they both mean? Well, vacant possession value is the value of the property if it's vacant. The market value is the value of the property with rent coming in, with a tenant occupying under a commercial lease paying rent. And obviously with our commercial valuations, where it's rent divided by the yield, it's a multiplier applied to the rent. So obviously if there's rent coming in, then that property is going to be worth more. That's how commercial valuations work. But with vacant possession value, what a valuer will do is they will basically say, right, let's assume this property is vacant. It might take 6 months to let. So they will take 6 months off the average rent over a certain period of time, maybe 5 years. And they'll take off any rent frees, etc., that or capital they might think might need to be paid. So basically, the net rent that they come out with is lower than the market rent. So yes, so basically, this is how valuers are being instructed at the moment. And even if you're a cash buyer, you want to buy on the basis that you may need to get some debt, because at the end of the day, even no matter how much money we've got, we may want to raise finance against a property, and therefore buying as if you're assuming that you're getting debt is a really valuable way of doing it. And I use Callum Brooks at Bond Finance. A lot of my clients do, and we'll get Callum on a podcast episode very, very soon. And what that means, and he will talk in a lot more detail about this. But basically, what you want to do is get your valuation as close to market value as you can on the basis of vacant possession value. And so that is buying properties where they're going to let pretty quickly, and that you can prove to a valuer that's the case. So I will always say to clients, I always prepare my own valuation reports. Prepare a valuer's pack so that you can give that to a valuer. And in there, what you want to do is you want to be proving that comparable properties or the subject property can let really quickly. So how do you do this? Well, first of all, you could buy the property cash, and then you could refinance it. So basically, you can prepare a valuer's pack. I would always recommend you prepare a valuer's pack with comparable evidence, and you'll get the comparable evidence from commercial agents, commercial valuers, etc. So you want to be preparing a valuer's pack, and you want to be giving that to the commercial valuer, the bank's valuer, and you want to be discussing the subject property. So, for example, if you buy a vacant property, and we all know that buying a vacant property and getting it let can really add massive value to a commercial property for the reasons that we're discussing in this podcast today. So, if you buy a vacant property, what you could do is you could actually get that property let before you go for finance. So you can buy with cash, with private investor finance, on a bridge, and we'll talk about bridging finance in a minute. And you could then do your asset management, get the property let. Now, what you want to do to optimize that, obviously, is get the very best agent in the market to do that for you. I would always recommend incentivizing an agent to get that property let for you. And so you basically want to get that property let as soon as possible. I've got a client who recently bought a property at auction. There was one retail unit vacant when he bought it, and that property, that unit had been vacant actually for about 6 months. It had been marketed openly, but it just hadn't gone. What he realised was that actually it wasn't on the market with the best agent in the town. So he spent £3,000 on doing a quick paint job, just making it look nice. He got the best retail agent in town to market it. He incentivized them to get it let before a certain time period, and they got it let within 6 weeks. So that property would be on the market for 6 months. So when he's going on to term finance, he will, in his valuer pack, he will say that actually that property let within 6 weeks. And the reason it didn't let before was because it was on with the wrong agent or whatever it might be. And so that's the best evidence you can give to a valuer to say, actually, all you need to do is take off 6 weeks and maybe a bit of rent free. I think he's giving a month's rent free. So that's all you need to do is to knock off maybe 9 weeks from the amortized rent. So and if you don't have a vacant property, therefore you can't prove that, what you want to do is you want to be getting evidence from commercial agents on how quickly similar properties are letting locally. Now, the trick here is to buy properties that will let quickly. That's the name of the game. What you don't want to do is buy properties where there's loads of supply of similar types of property, and tenants will be basically playing you off against numerous other landlords, because then you won't get the best lease terms, you won't get the best rent, you won't get the best tenants. So that's a real problem. So the trick here is in choice of property. It's in niching. It's about understanding the supply and demand in a market, and then making sure that you take advantage of that. So, your niche, your sourcing really comes first in this, so that you can actually get the best finance. So playing the game of buying properties where the vacant possession value and the market value are really close together is where the game is to be played. And if you are buying cash and you want to understand before you buy kind of how a bank would value it, all you need to do is speak to your broker and ask who the banks use as valuers and instruct them on that basis. You can also put special assumptions in the valuations. For example, if I did this asset management, if it's got rolling 6 weekly leases, if I put them on 5-year leases, what would that do to my asset management? What would that do to my valuation? What would that do for my asset management? And what would that do for my capital value? So there's lots of different ways of instructing agents and valuers, but make sure you speak to your broker very, very early on the process. I always speak to my broker well before I put an offer out, actually, to understand what the art of the possible is on that particular type of property, and also where the wrinkles might be, so that I can actually reflect that in my offer, or that at least I'm kind of speaking to agents about evidence. Number one is looking for properties where the vacant possession value and the market value are very close together.
This episode is brought to you by Bond Finance Limited, your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
So now let's talk about the type of finance you can get when you're buying commercial investment. So we're looking at buying a commercial property. We might want to buy it on a bridge or cash to begin with. Why would we do that? Well, we do it because we want to basically buy it at one price. We want to do some asset management to it to increase its value so that we can go on term finance at a longer term, term finance at a better value. So that may not be the right strategy for you. You may want to buy on term finance to begin with, especially if you're just buying for yield and there's not much asset management to do. So speak to your broker early on about the options to do with that and the type of finance that you can achieve. But let's assume for the point of this podcast that you're going to do some asset management to the property. That might be letting a vacant property, that might be doing a lease extension, that might be reconfiguring a property and reletting it, that might be extending it or doing something physical to it. So you can go for bridging finance. You can also get that for buying at auction. You can obviously buy with investor cash. You can look at doing JVs. You can buy with your own money, whatever that might be. And as I said, buying cash at the moment is where you're going to get the best deals. So definitely look at that as an option for sure. So then the third thing really that we need to look at is in terms of what the banks are looking to lend on. So it's pretty obvious, like if there's a line of least resistance, let's follow it. And it's really one of the cornerstones of niching that I recommend to clients, is what I do myself as well. So follow the money, basically. So how do you follow the money? Well, basically, you need to speak to a broker. You need to understand what banks are lending on. As I say, we'll get Callum Brooks from Bond Finance on this podcast very soon, and he can talk you through the ins and outs of what the banks are looking for. But as an overview, what they're looking for at the moment is multi-let space. They want units that have more than one tenant. In fact, the more tenants, the better. And why is that? Well, it's pretty obvious. If you were a bank and you had one tenant paying the rent, that's risky. Because if that tenant goes under or defaults on rent, then obviously that mortgage isn't getting paid. But if you have maybe 10 tenants in that property, or the owner has 10 tenants in the property and only 3 are needed to pay the mortgage, you can see how that's much, much less risky for a bank than just having one tenant. So multi-let space is what they're looking for. And if you get multi-let space, they're willing to lend on higher loan to values and potentially even lower rates. Obviously, speak to your broker about that. Now, there's a difference between the high street banks and the challenger banks, and you need to understand that. Challenger banks like Shawbrook, they're really keen on this multi-let space. High street banks are a little bit risk averse to single let space, but still I think you're going to get a better deal if it's multi-let units. They just take longer. The loan to values are lower, but the challenger banks really, really like multi-let space at the moment, particularly if it's multi-let office or multi-let industrial. They do like multi-let retail as well. So how can you take advantage of this? Well, first of all, if you're buying multi-let space, then you're going to get a better deal. You're going to get a better finance deal. But second, you can create the kind of asset that banks are looking for. So, for example, if you buy an industrial unit that's, say, 10,000 square feet, you can actually potentially buy on a bridge or buy cash or have a creative deal even where you can do an exchange delay completion or whatever else it might be, an option where you can do some work to the property. And you can then split that space into smaller units. Now, Obviously, the obvious kind of question is, well, what size units do they need to be? And the answer to that is whatever is going to let quickest in the market and where you're going to get the best lease terms and the best rent and tenant. So what you need to do is you need to understand that market. Another reason to niche your strategies. So you can speak to commercial agents, you can use your own knowledge, you can speak to tenants direct, you can work out where there's lease voids and you want to tailor it to those types of tenants. And quite often, if you're dividing space like that, you might want to have different size units that cater for different markets, or you might want to have all the same size of units. It just depends on the strength of that market and the tenant demand. But what you're basically searching out is tenant demand. And when there's lots of tenant demand, when there's competition for leases in particular, you're going to get longer leases, you're going to get better rents, and you're going to get better tenants. So basically, it will play in the landlord's favour. So if you buy a larger space, whether it's retail, office, industrial, whatever it might be, and you carve it into smaller units, as long as there's demand, and obviously there isn't in every market, so you need to understand that, then very often you can create multi-let space, which the banks will be very keen to lend on. And obviously, if you do create multi-let space, then the longer leases you can get on that space, the better. If you can get 5 to 10 year leases on that space, that the banks are going to like that much better than maybe 1 year rolling leases, where obviously there's more risk. And all banks are doing is underwriting. They're looking at the risk. And so you need to make an asset as make them as confident and make it as low risk as possible for the banks. And of course, subdividing a commercial unit is nowhere near as onerous as subdividing a residential unit, because you haven't got all the kind of soundproofing and all the building regs that go with it. What you're looking at, especially in an industrial unit, for example, is you're looking at putting a breeze block wall in place. It's not that expensive to do. You're talking in low tens of thousands rather than hundreds and hundreds of thousands that you would be with splitting residential. So it's really cheap to do it. The banks love it. Multi-let space is definitely the way ahead. So definitely playing this commercial finance game at the moment is the way you're going to get as much of your money out as possible. And at the end of the day, that's very often the name of the game for commercial investors. Not always, because very often investors are buying for yield just to put their money into kind of good yielding properties to get a return. But if you're looking to get your money out, you're looking to asset manage, you're looking to add value, then going along the line of lease resistance, finding out what banks want to lend on, and kind of buying the right kind of asset or creating the right type of asset is definitely the way ahead.